All right, Talk Tickers listeners, earnings season is in full swing. And you know what that means.
Time to break out the calculators and see which companies are actually making money.
Well, we don't actually use calculators.
Right, because we've got spreadsheets.
A spreadsheet's hotter than a Shondaland love triangle.
And more dramatic than a Love is Blind reunion.
Speaking of drama.
Oh, you want to talk about drama?
Let's talk Netflix, baby.
Their stock is like a roller coaster.
More twists and turns than an Ozark plotline.
And just as addictive.
Well, today we're diving into their Q3 2024 earnings call.
To see if this streaming giant is still on top.
Or if they're headed for a cliffhanger ending.
Okay, so let's start with the basics.
Their Q3 revenue came in at a cool $9.8 billion.
A cool $9.8 billion. Yeah, that's up 15% year over year.
Not too shabby.
Not too shabby at all, and their operating margin is a respectable 30%.
Up from 22% last year. So they're definitely doing something right.
They're definitely doing something right, but hold on to your popcorn because here comes the plot twist.
Oh, I do love a good plot twist.
Global streaming paid net additions.
Global streaming, what now?
It's how many new subscribers they got.
Got it. You know, I always forget what those industry terms mean.
Well, they're down to 5.1 million from 8.8 million in Q3 of last year.
Oof, that's a pretty steep drop.
Steep, yeah. And this is even with that whole crackdown on password sharing they did earlier this year.
Oh, yeah. The love is no longer sharing a password campaign.
You know, I'm not sure guilt-tripping people into paying for their own accounts was the best growth strategy.
It's like they're trying to win a staring contest with a teenager glued to their phone.
I just don't want to blink.
But seriously, what's the deal with this subscriber slowdown?
Well, they're trying to spin it as a focus on engagement over sheer subscriber count.
Engagement. Is that like corporate jargon for please don't cancel your subscription?
Pretty much it's all about how much time people are actually spending watching their shows.
So they're basically saying it doesn't matter if we have fewer subscribers as long as the ones we have are glued to their screens.
Exactly. They even boasted about healthy engagement numbers in their shareholder letter.
Oh, shareholder letter's always good for a laugh.
Especially when they use phrases like owner households.
Owner households, what is this, a timeshare presentation?
It basically just means people who are actually paying for their Netflix accounts.
Ah, so the opposite of those of us who are still using our ex-roommate's uncle's login. But back to this whole engagement thing, how do they even measure that?
Well, according to their definition, even if you just glance at your TV while Stranger Things is on in the background,
You're considered engaged.
you are basically a captive audience.
I knew it. They're tracking our every move.
Every click, every pause, every time you rewind to see Regé-Jean Page one more time.
Hey, a good Bridgerton rewatch is never a bad thing.
Never a bad thing, but I digress.
Right, engagement content. You know what we're talking about.
Well, that's where things get a little interesting, or should I say a little patchy.
Patchy. That doesn't sound good.
It doesn't remember those Hollywood strikes.
Oh yeah, those were a whole thing.
A whole thing that apparently even Netflix isn't immune to.
You're telling me even streaming giants can't escape the wrath of a Hollywood labor dispute?
Apparently not. Their shareholder letter admitted that the 2024 content slate has been a bit patchier than normal.
Okay, time to pull out the CEO decoder ring. What does patchier than normal actually mean?
We may have greenlit one too many reality shows starring former child stars.
You're probably not wrong.
I'm rarely wrong, but seriously, those strikes caused major production delays.
Which means less of the good stuff.
Less Stranger Things, less Bridgerton, less Squid Game.
Okay, now that's just cruel.
They did have a few bright spots, though.
Oh, like what?
The Perfect Couple pulled in a respectable 65.2 million views.
Nicole Kidman strikes again.
And Ryan Murphy's Monsters, the Lyle and Eric Menendez story, snagged 54.6 million.
True crime never goes out of style.
Never. And neither does anything starring Nicole Kidman.
Okay, but what about the rest of the world?
The rest of the world.
Yeah, you know, Netflix isn't just a U.S. thing.
Right, well, their global performance is about as consistent as my dating life.
Oh no, what does that mean?
A real mixed bag.
A mixed bag. Okay, well, let's break it down then, geographical speaking, of course. All right, so mixed bag. Let's unpack this mixed bag of international Netflix intrigue.
Okay, so first up, we've got North America, still their biggest market.
The land of supersized popcorn and binge-watching marathons?
They saw a 16% revenue increase year over year.
Not bad, not bad.
Not bad at all, and it's driven by both membership growth and that thing they call IRM.
IRM. Now you're just messing with me.
I would never dream of it.
Is IRM like a new streaming service where you control the remote with your mind?
Okay, that would be pretty cool.
Right.
But no, ARM stands for average revenue per membership.
So basically, how much money each subscriber is shelling out every month?
Exactly. It's the price we pay for our collective Netflix addiction.
Well, it's worth it for those glorious skip intro buttons.
But let's move on to other regions, shall we?
Oh, yes, please. International intrigue awaits.
So Europe, the Middle East, and Africa, or EMEA, as the cool kids call it.
EMEA has a nice ring to it.
It does. They pretty much mirrored North America with a 16% revenue jump, so things are looking good there.
Good, good. What about those telenovela enthusiasts in Latin America?
Ah, Latin America. That's where things get a little more complicado.
Complicado. Is that Spanish for we may have a slight problem?
Something like that. They only saw a 9% revenue increase, and get this, they actually experienced a small subscriber dip.
A dip.
Mm.
What happened? Did they run out of elite episodes?
They're blaming it on recent price hikes and a softer content slate.
Softer content slate. Sounds like someone needs to call their Hollywood agent.
Right. But hey, they're predicting a comeback in Q4 with two big Latin American productions, 100 Years of Solitude and Senna.
One's a literary classic, the other's about a Formula One legend. Talk about covering your bases.
Exactly. They're casting a wide net.
Smart move. Smart move. But let's be honest here. There's one region that's carrying Netflix on its back, like Atlas carrying the weight of the world.
Oh, you mean Asia Pacific?
The land of K-dramas and Bollywood blockbusters, am I right?
You are. They saw a whopping 19% year-over-year revenue increase in Q3.
19%. That's like finding a $20 bill in your pocket, but way more exciting.
Way more exciting, and they're attributing it to, you guessed it, their investment in local content.
It's almost like people enjoy watching shows and movies that reflect their own cultures. Who knew?
Revolutionary, right?
Absolutely.
Yeah.
But let's talk about the elephant in the room, or should I say the ad in this streaming service?
Yes. Ad's the necessary evil.
How's that whole ad-supported plan working out for them? Are people actually okay with watching commercials in the age of streaming?
Believe it or not, it's actually exceeding expectations.
Really?
Really, the ad-supported plan now accounts for over 50% of new signups in regions where it's available.
So people hate ads, but they hate paying full price even more.
It's a classic dilemma.
The eternal struggle. But hey, at least Netflix is finding ways to make money.
That's what they're in the business to do.
True, true. But what about the OG streaming giant in the room? YouTube. Are they friend or foe in this whole streaming saga?
It's a bit of a love-hate relationship, if you ask me.
Oh, how so?
Well, Netflix uses YouTube to promote their own shows, all the Stranger Things trailers you see everywhere.
Guilty as charged.
But at the same time, YouTube has an endless library of free content.
Which poses a direct threat to Netflix's whole subscription model.
Exactly. It's like trying to sell bottled water next to a free water fountain.
A very tempting free water fountain.
Very tempting. But Netflix is betting on quality over quantity. They're all about those prestige shows and movies you can't find anywhere else.
So they're going for the whole, we're like HBO, but with more reality TV vibe.
Essentially, yes, but they're also not afraid to experiment a little.
Oh. Like what kind of experiments?
Remember those rumors about them getting into live sports?
Wait, seriously. Is my dream of watching the Super Bowl and Bridgerton back-to-back finally coming true?
Maybe eventually you're starting small, a couple of NFL games on Christmas Day, a few comedy specials, even the Mike Tyson versus Jake Paul boxing match.
Mike Tyson and Jake Paul. Now, that's a pay-per-view event I can get behind.
They're testing the waters, seeing if they can recreate that live event magic.
Well, I applaud their boldness.
Yeah.
But enough about the present. Let's talk about the future.
The future of Netflix.
The future of Netflix.
Right.
What do their 2024 and 2025 projections look like? Give me the numbers.
Okay, so for the full year 2024, they're projecting 15% revenue growth and a 27% operating margin.
Not too shabby. Not too shabby.
Not bad at all. They also anticipate generating somewhere between $6 billion to $6.5 billion in free cash flow.
Free cash flow. Is that like finding money in your couch cushions, but on a corporate scale?
Basically, yes, it's the cash they have left over after covering their expenses.
And you know they're going to spend it.
Oh, they'll find ways to spend it, trust me.
Hopefully on more binge-worthy content.
One can only hope, but what about their long-term vision?
Yeah, where do they see themselves in this ever-changing streaming landscape 5 years from now, 10 years from now?
Well, looking ahead to 2025, they're forecasting revenue between $43 billion and $44 billion.
Okay, so continued growth, but at a slightly slower pace.
Exactly. The streaming gold rush might be slowing down, but Netflix is clearly in it for the long haul.
They're like the marathon runners of the entertainment world.
They're not sprinting, they're pacing themselves.
Smart strategy. Smart strategy. But let's bring it back to our Talk Tickers listeners. So, bottom line, should our listeners be hitting that buy button on Netflix stock, or is it time to cut their losses and run?
Well, I wouldn't hit the panic button just yet. They're still a powerhouse in the streaming world.
True, but they're facing more competition than ever before.
That's the name of the game these days. Everyone wants a piece of that streaming pie.
It's like a digital gold rush.
Exactly. But Netflix has a few things going for them.
Like what?
Well, they were the first ones to really crack the code on streaming.
The OG trailblazer.
Exactly. They built a massive global audience.
And they're not afraid to spend money to keep those subscribers happy.
They're all about that high-quality content, those big-budget shows that everyone's talking about.
Plus, they've got that whole Stranger Things nostalgia factor working in their favor.
You know, I still get chills thinking about 11 and those Demogorgons.
Me too. Me too. Well, let's talk about their foray into the world of gaming for a minute.
Gaming. Oh, yeah. Their master plan to become the Netflix of video games.
It's a bold strategy, Cotton. Let's see if it pays off for them.
I mean, they've got the resources, they've got the brand recognition.
But do they have the gaming chops to go up against the likes of Microsoft and Sony?
Only time will tell, but hey, stranger things have happened.
See what you did there.
I couldn't resist.
Well played, well played. So, final verdict on Netflix.
It's a hold for now. Keep an eye on those subscriber numbers and their gaming strategy.
And maybe stock up on Eggo waffles just in case.
Always a good idea, but on that note,
It's time to wrap up another thrilling episode of Talk Tickers.
we decoded the earnings, deciphered the jargon, and maybe even made a few bold predictions along the way.
And remember, listeners, never make investment decisions based solely on the ramblings of two podcast hosts.
Especially when those ramblings involve fictional creatures from the upside down.
Exactly. Until next time, happy streaming and happy investing.